Greetings, Accounting 2 students. So this is going to be the topic of this video. We're going to look at an investment in bonds, which I have abbreviated HTM bonds. What does that stand for? Held to maturity. Okay. So as such, what are we looking at? We are looking at this situation here. It's got to be a debt security because stocks don't have a maturity date, yeah? What's the valuation? Amortized cost. So we're going to be buying bonds at an amount greater than $1,000 or an amount less than $1,000. I'm going to amortize that premium or discount. The balance sheet classification is long-term. It'd be in the investment section. There are no unrealized gains and losses. Okay, so it doesn't matter whether the price of the bonds goes up or down after the initial purchase. Not recognized. HTM Securities. We intend to hold them to maturity. Yeah? Okay, so let's look at the accounting for this. And I stole some numbers from the bonds homework problema. This was letter A, where we calculated the issue price of the bonds under what circumstance? That the bond rate was 5.4%, which we cut in half to be 2.7, and the market effective or yield rate is 2.5 semi-annually, 5% annually. And the term was 10 years, so we doubled the and made it 20. We came up with this number. It was actually $1 different. That's because these factors were somewhat truncated in the original calculation. In any event, I'm going to go with that number, 721,825. And we made this entry at the time. We said, okay, we sold the bonds. We, the issuing corporation, sold the bonds for 721,825. And we credited bonds payable for the face amount of the bonds, or the par value of the bonds, as some refer to it, $700,000. The difference was a premium, $21,825, which we put in a separate account. And then over time, we amortized that, which again, what does that mean in English? We make this balance go away over time. So we'd be debiting bond premium. All right, now let's play make-believe that we bought all the bonds, or we bought part of a bond issue. In other words, we bought 700 bonds. So what is that going to look like if we are the purchaser of the bonds, which is now going to be an asset, right? Yeah, it's going to be in the investment section. We buy the bonds. I use this account title because it's descriptive. You can see what we're doing. HTM Securities. Okay, so that's going to be our asset account. Long term goes in the investment section. We credit cash. The observant student will note there is no bond premium account set up. The bond premium is baked into the asset amount here. Yeah, 721,825. All right, so that's the difference between bonds being issued and bonds being purchased. There's no separate premium, and there won't be a separate discount account either. Now these numbers here, what are these numbers over here? This is the chart for this particular bond issue, which was part of the homework deal. And I carried it out the entire 20 periods just to make sure that everything was correct. And you can see it amortizes to $700,000. So we have the exact same numbers, the exact same interest rates, the exact same number of bonds, but the accounting now is we are now the recipient of the semi-annual interest payments, which are these over here, yeah? So the cash doesn't change. That's going to be $18,900, but this time we're debiting our favorite account, cash. And we are crediting interest income for this amount here, $18,046. And how do we get that number? We got it the same way you get the interest expense on a bond payable. You take the carrying value, which is 721,825, and then you multiply times the effective interest rate, which semi-annually is 2.5%, to get the interest income, which is rounded off to 18,046. All right. So that's our credit. But now our debits don't equal our credits. So we are going to credit HTM Securities, that's the asset account, for the amount of amortization. And what's going to happen over time is the carrying value of the bond is going to decrease. Yeah? So this is a debit. Yeah? This is a credit. And we're going to gradually reduce the carrying value over the period of 10 years. And eventually it'll hit the 700,000 now. We hold the bonds for the 10 years and we get to 700,000 at the end. What do? We debit our favorite account, cash, and we credit HTM Securities. Of course, we're not going to carry it out that far. Now, the second semi-annual interest receipt is these numbers right over here. Still getting $18,900. The credit to the asset account is a little bit higher because the difference between the interest income and the cash is now greater. And there you have it. Those are the same numbers we use for the bonds payable. Two differences. Number one, there is no separate premium or discount account. In this case, there's no premium. And number two, this is not going to be interest expense, yeah? It's going to be interest income. And we're going to be getting cash as opposed to paying cash. And there you have it. Same numbers we used for the bonds payable. And there's another method, of course, the straight line method of amortization. So let's look at our numbers again. This entry would be the same regardless of which amortization method you're using. Okay. The cash is not going to change, right? The cash is basically etched in stone. Right? When the bonds are issued and the rate is given, that's going to happen no matter what. So how do we get the interest income? Well, how much of a premium did we want to amortize? We wanted to amortize $21,825, yeah? $21,825. So we take that number and we divide by, well, how many times are we going to make this entry? Let's say 20, 10 years, 109,125 approximately. There it is. So we calculate this number here, and then, like good solid accountants, we want our debits equal to our credits. So this is essentially a plug figure. You just add up the two debits, and that becomes your credit to interest income. And then you make the same exact entry every 6 months for the remaining term of the bonds. Now this is a simplification. Why is it? Because in the real world you need monthly financial statements. So what you really have to do is make a monthly adjusting journal entry to get the interest income on the books, or for that matter, if you're the issuing corporation, the interest expense on the book every month, which would result in us having a zillion entries on this page. So we're not going to do that, all right? But that's the reality. Now, what if we bought the bonds at a discount? You were thinking that, weren't you? Okay. So use the numbers, again, stolen from the bond homework tab. We had to make this calculation here, see, where the bonds are issued for $594,879. So I just copied those numbers over here. I'm saying, okay, let's suppose we bought all those bonds, $600,000 worth. All right. So this was the entry we made for if you were issuing the bonds and you're owing the money, yeah. And you can see we have a bond discount of $51.18. And what are we going to do? Well, we're going to debit the asset account for the amount of cash that we paid. And what's baked into this number here, this asset balance, is the discount, yeah? And so what we're going to do over time is we're going to bring the carrying value up to the face amount of the bonds, or the par value of the bonds, which is always the nice even multiple of $1,000. Okay. So, all right, what happens? Well, we got the cash. The cash is what? It's etched in stone. It's 2.9% of 600,000. So the annual rate is 5.8. So we debit our favorite account, cash. We credit interest income for how much? For, you guessed it, the carrying value times the effective rate, the market rate, or the yield. They all mean the same thing. So we take this 594, 882, multiply times 3%, and we get 17,846 rounded. That's the number. Carrying value times effective rate. So there's our interest income. Here's our cash. And the difference is going to be a debit to HTM Securities. So we are increasing the asset balance over time. So we want this eventually to hit 600K, which, if we do it correctly, is going to happen. It's a beautiful thing, yeah? All right, so what does the second semi-annual interest payment look like? Well, it's the same configuration of accounts, but now what happened? The carrying value has gone up a little bit. How much? Went up by $446, which is going to slightly change your interest income. So now it's $17,860. You find the difference. There's your amort of, little editing here, right? Amort of discount. It's $460. Zip, zip. There's your second entry. All right. Effective interest method, which is preferred, especially if there's going to be a material difference between the two methods. What two methods? Well, the other method is straight line. This is the same. Doesn't matter which method of bean counting you're using, right? When you buy the bonds, what do? You debit the asset account, you credit cash. 511.80. That's going to be our amort of discount. And where do we get that number from? Well, what was the discount? The discount in total is 51.18. The difference between what we paid for the bonds versus their par value or face amount. So it's 51.18, and this is a 5-year bond. So we're going to divide by what? 10. And guess what it comes out to? It comes out to 511.80. So I'm going to put that over here. Divide by 10. So semi-annual, and all of my problems are semi-annual, so you're always doing this. What are we doing? We are always halving the interest rates and doubling the years. So 5 becomes 10, 10 becomes 20, or whatever. It's always doubled. All right, that's how we do it. That's a smattering of HTM Securities. This could get really gnarly if we bought the bonds in between interest rates, interest payment dates, I should say. Like, say we bought these bonds here on Valentine's Day. We didn't buy them on January 1st. Well, this could get to be a very gnarly calculation. And even worse than that is if they were available for sale securities. What would we do in that case? If these were available for sale, in other words, we're not planning on holding them to maturity, then we're looking at this situation here. And we'd have to go through that same thing with amortizing, but then in addition to that, we would have to adjust to fair value at each balance sheet date. So, I mean, this is somewhat of an accounting nightmare, which we save for what class? Accounting 202, Intermediate Accounting Part 2. So I made up these little homework problemas. I left my calculations over here. I love to steal this stuff from the formulas tab. It comes in very handy. So I put in I equals 2.1. These are semi-annual bonds, yeah? So that's going to be what? 4.2. And these are 5-year bonds. So I'm using 10. And these were automatically calculated based on these totally exciting formulas that are on the formula tab. And I multiply across, and I got 1,013.40. So these bonds go out at a premium, yeah, a little bit more than $1,000, because this is what? This is 2.25%. What's 2.25%? That's half of the bond rate, which is 4.5. 2.25 is higher than 2.1. Bonds will sell at a premium. So we got some questions on that: effective interest method, straight line method, and then over here, do it again. This time, the market rate, the effective rate, or the yield, again they're all synonymous, is 5.2, so we use half of that, and it's 6-year term, so we go with 12. We double the years, yeah. And the bonds are going to pay interest at 2.5% every half year, yeah, which is what it says here, 5%. That's the annual rate. You have it. You're going to pay $25 every half year for these bonds. So they're going to sell for $989.80, which is the number up here, and there's 80 bonds. Okay, there you have it. See what you can do with these. Enjoy. Until next time, signing off.